you for that. Right now, we're going to welcome our next live guest of the morning. We've got Peter Sand with us, who is Chief Analyst over at Xeneta, joining us all the way from Copenhagen, Denmark. Peter, welcome back to the show once again. We're excited to dig into what's been going on with you.
Thank you so much, Kayla, for having me back. There's a lot of things going on, so I'm really happy to be back and share those insights from Xeneta with you guys.
Absolutely. We're talking once again about the biggest word in the room, disruption, and it really just doesn't stop. So what have you guys been seeing on the disruption front lately?
Well, the one thing that stands between a full resolution of all the strained supply chains and where we are now is the fact that it's still a whack-a-mole game. I mean, we may see obstacles to trade being torn down in one part of the world with new obstacles coming up in another part of the world. Just let me give you an example on the COVID disruptions that we tend to see still in many places in Asia. Good news to see Japan is finally welcoming back tourists, but in the essential export ports and manufacturing hubs in Asia, and particularly China, they are still quite significantly disrupted by local COVID measures that is preventing production from being carried out the way it should be, from truck drivers to delivering boxes to the terminals in and out. Of course, it's mostly of essence to container shipping, what goes on in the main importing areas, like where you guys are in North America and where I am in North Europe. So I guess that's why we tend on the overall to conclude that things are moving in a direction of eased supply chains. We can see that also from spot rates definitely falling for consecutive months now. But I think there's still a lot to take away from congested areas. Let me just point you in one direction on the transatlantic trade lane, predominantly that from North Europe into US East Coast. The spot rate on that has been flatlined now for several months due to massive congestion at either coastline. So there's still quite a lot of disruptions around, but in essence, of course, the headwind that we face from global economics, inflation, higher prices, and uncertainty in general. People like you and I spending money on services and not only goods is, of course, also influencing the direction that the container shipping market and global logistics are taking at the moment.
And looking at outlook, given the fact we do have so much inflation and consumer demand shifts, in spite of the ports being backed up, are we expecting any kind of seasonality in terms of a surge with a holiday, or is it a situation where the high inventory is taking its toll?
What we have seen in the earlier month of the year already is that a number of major importers into US and predominantly have really stocked up because that, of course, was one way also to deal with the poor reliability from global carriers, the lack of real insights into future demand as headwinds grew stronger and faster, and of course, that whole quest for bringing more resilience into your supply chain. So I guess a lot of shippers have already some sort of front-loaded their future demand. So in terms of a classic and traditional peak season, that's definitely not what we expect at Xeneta. We tend to see that a lot of the cargoes that have been rerouted into to the North American continent, away from the potential strikes and disruptions on the US West Coast, still are hesitant bringing those volumes back to the West Coast. So we still see very high level on congestion on the US East Coast as still the go-to place if you need to be sure that that cargo is not, say, massively disrupted from West Coast issues. But in essence, everything seems to be working fine on the West Coast right now. But of course, we cannot see the get out of jail card yet, as the labor union and the PMA are still now getting into to their final rounds, trying to battle out the most present issues, the level of port automation, and of course the level of salaries going forward.
Peter, a couple of weeks ago, we were talking here about what we're kind of most concerned about looking forward ahead into the rest of Q3 and the start of Q4. And I talked about the point where the American consumer will kind of have their moment when they realize that, wow, we're spending like we still have the buying power that we did back during the COVID times. And they really quite haven't realized that their dollar isn't going as far. They're still spending like their dollar's going as far as it was. Are you guys going to have that same kind of, I guess, transition, that flip, that moment of realization with the consumers in Europe? Or do we think that the American consumer is a little bit more, I guess, hopeful of how their dollar still exists and the power that they have, even if that hope is misplaced?
I think that the American consumers tend to surprise on the upside when it comes to demand. So fortunately, I mean, call it Halloween, call it back to school, call it Golden Week, call it Black Friday or something like that. There's always a good reason to go down and get something from the mall. And if we look at the most recent U.S. retail sales and adjust those for inflation, the level of sales is still holding up to a positive level. It's not by much, but it's still around the $600 billion mark on a monthly basis. So it definitely seems also that the strong numbers in terms of employment in US is holding up. So there are no, you can say, red lights around. Of course, there's yellow lights if we go by some sort of, say, traffic light indication, but it's not red light everywhere I look for sure. And I think that if we translate that into to global logistics, into to container freight rates also going forward, I think that is preventing freight rates from falling out of the sky into the ground at rapid pace. Realizing that, of course, we have still seen some significant decline in spot rates from past peak levels to the extent of some 1/3. And that, of course, is significant. We're still at very, very elevated levels. So I think the consumers are still doing a good job in preventing the market from falling apart and a lot of drama to be played out. But in the end, also, what the global supply chains need was exactly what we see right now, an easing of demand, giving reason for retailers to reconsider and find that new normal level going forward, for carriers to redeploy the ships into the trades they used to ply, and of course for the key essential ports and terminals in US West Coast, US East Coast, Hamburg, Rotterdam, to mention some of the most important one, and of course also Felixstowe, where we have 2,000 dock workers on strike right now. I mean, they still need many months, most likely also half a year to a year, really to work through all the boxes that they see right now sitting on the docks, not being picked up or being, say, delayed pickup by the shippers. So many things still need to be dealt with before we can really, say, hit the running in say 12, 15 months, where it looks like something that we may recognize from pre-pandemic situations. So plenty of interesting stuff that I'm not really sure that we're going to talk and use the word disruption many times over during these coming quarters also.
Final question, well, real quick. Ocean freight outlook and contract versus spots. We see that ocean spot rates are starting to improve if you're trying to ship things. Will contract rates remain high, or do you expect that they may see some easing as people renegotiate?
I think as called out by Xeneta quite some month ago, we expected also the Far East to US East Coast trade lane also to see that trend of spot rates falling below the long-term contract rate. And only last week, we literally saw that happening. And what does that mean to shippers, of course? Well, it means that you may want to reconsider how you position yourself in your next tendering round with carriers and freight forwarders, because obviously 1 year ago, it was a no-brainer to sign long-term contracts for a year or perhaps even more, because you were fighting for everyone else for capacity on board those ships. Right now, it seems as if the tables have turned just a little bit. I mean, the carriers still hold most of the trumps, but shippers are definitely also in need now to be 100% on top of their own logistics requirements in order to get to that negotiation table and positioning himself as a must-have customer to the carriers they talk to about long-term contracts, because obviously they still need to secure capacity for their most essential products on their key trade lanes, while they may want to play it more smooth or through on the spot market where they are moving cargo, which may not be, say, urgently needed to the same extent as the essentials. So I think at the end of the day, it rests very much on the individual shippers. This is mainly, of course, the rest of the bigger ones, but the smaller ones may definitely also have an upside in playing the market somewhat different, being cautious, shortening or creation of the contracts, and just sit it out. I mean, we are in a downward trend, sure, with some volatility for the next 12 months or so, for sure. But the trend seems clear. So you may not be losing out much from hesitating right now and signing, as we also tend to see that the long-term contracts are moving sideways and trending down also to some extent. Of course, being aware of the added benefits from signing that, which will also attract many shippers in a market which is still thick of uncertainty.
Right. Peter, thank you so much for joining us this morning. Always interesting to get your guys' perspective from Xeneta, of course. We'll talk to you soon. Right now, we're going to head back over to Sydney Edwards, who's got an update for our top stories today.